Hello, and welcome to the Future Ventures Scaling with Clarity podcast. Today, I'm super excited to have Robin Smith from Corinium Capital. He's the managing partner of Corinium Capital, an operator-led investment firm. His focus is on acquiring and building mission-critical software and tech-enabled businesses across the United Kingdom. With over 2 decades of experience leading and scaling B2B software companies from early stage growth through to 200 million in revenue, he's now taking a different approach to ownership, long-term, hands-on, and deeply aligned with founders. At Corinium, Robin works directly with business owners, navigating succession, offering an alternative to traditional private equity, one built on continuity, operational leadership, and patient capital. Welcome to the stage, Robin.
Hey, Maxim. Thank you very much for having me on.
My pleasure. Super excited to talk to you because you're focusing on the future, and so at the moment the B2B SaaS market is in such a volatility, and software overall. Especially with the rollout of the LLM models and new features, new apps, building of the super apps. So I'm super excited to talk to you and just kind of get your perspective on where the future is headed. So why don't we start a little bit with who is Robin Smith? What do you like to do in your spare time? How did you come into venture?
Yeah, sure thing. So I'm a husband and father of an 11-year-old and a 4-year-old. So they definitely keep me on my toes.
Good.
In my free time, I try and get onto the golf course a fair amount of time. So I'm a 21 handicapper, so definitely have the eyes on the Masters over the next couple of days, and also a very keen cricketer. So those are my kind of two principal hobbies. I'm a big cricket spectator as well, so I play cricket but also watch cricket. Member of the Oval in London, so I get to go and watch a good amount of cricket there. And from a work point of view, I'm very much a kind of transitionary point in my career. So I've worked in enterprise software for 20 years, across pretty much every single kind of ownership model. So I've done bootstrapped, I've done venture, I've done private equity, and I've done public. A majority of those 20 years, 15 or so in go-to-market roles. So I started straight out of university as a sales rep and carried a bag and had a number, and sold enterprise software for 15 years across a range of verticals. And then more recently was chief operating officer of a private equity owned portco. We were just over 1,000 people, and was responsible for doing a pretty fast-paced and large roll-up of our competitors. So I was responsible for leading about or over 200 million euros worth of acquisitions in a kind of 18-month period, which was a heck of a learning experience. Gave me a lot of exposure to structure, process, advisors, a network of folk in Europe that were able to assist around all that kind of stuff. And I left that business just under a year ago and decided that I really wanted to go back to much smaller businesses, and fell into the discipline market community of folk who are involved in entrepreneurship through acquisition. Prior to this time last year, I'd never heard of a search fund. Looked at structuring a transaction as a search transaction, was strongly advised by a load of my friends not to go down that path because the transaction I was looking at was very competitive. And that then introduced me to a number of low mid-market PE firms, family offices, and independent sponsors. So yeah, big kind of change in career. I'm in my mid 40s. I was going to say early, but probably mid is closer to the mark. and really was excited about the opportunity of looking to acquire and then run a business with Patient Capital.
Yeah.
That acquisition didn't go to plan, and I think
What
there's a really
made the deal fall apart, Robin?
So I absolutely will go through that. I think just a kind of a note really to your listeners that I think everyone is obsessed with success and giving the image and prestige of always winning. And the reality is, particularly in M&A, like transactions are really difficult and a load of them don't go to plan.
Yeah.
And particularly if they're competitive, they're always winners and losers. And I was one of the losers. So definitely a kind of message to your audience is, let's embrace failure and let's talk about not only the stuff that does work, but let's be candid on the stuff that doesn't work, because you can only learn from mistakes, right? You can learn a bit from success, but I think learning from mistakes is so much more important. So anyway, that's me on my high horse a bit, but it was a fascinating journey and isn't closed yet. So I got to know the founder of a bootstrapped SaaS business, vertical SaaS business. It was doing between 5 and 10 million sterling of ARR. Good metrics. Successful business. Was founded about 20 years ago. And in terms of thesis, it was squarely in the sweet spot of what I was looking to do. So the founder was heading towards retirement, starting to think about retirement. He had founded the business 20 years ago and had a great run, and had got to a point where he was starting to think kind of what was next. And he was quite keen initially not to sell to private equity, and initially was focused on trade sale. And I said, look, I'm a very different option. I'm not looking to buy this purely as a kind of transaction that I'll flip in X years time. And I'm not a kind of traditional GP in so much as I'll be stepping back and bringing in a leadership team. I want to run this business and I want to grow this business with you involved or with you stepping back, up to you. And I can give you the flexibility on that transaction looks like. And we went into that process. So he had a dedicated investment bank on sell side. I appointed a dedicated mid-market advisor on buy side for me. Had capital structured across a number of family office investors. But being candid, wasn't at a point where I could get to the clearing price that sell side were looking for from his side. We were a few turns of revenue kind of disconnected on valuation, and this was at the back end of last year, so before the market dislocated earlier this year. So I didn't make it through round one bids, and that was really tough. So I invested a majority of last year in a single transaction. I knew that was really high risk, and had some really good counsel from friends who said, the chances of you succeeding here in a competitive sell-side led process are, you've got to be really realistic. And it sadly didn't go to plan. But the founder and I are still, friends and chatting, and he's getting towards the end of that process now. So it was, I learned so much. It was effectively like doing a condensed MBA at the midpoint in my career. And I think a lot of people in a similar situation would have kind of licked their wounds and looked at going back to employment. But if anything, it's actually galvanized my desire for this path. But starting in 2026, looking at things through a slightly different lens and heading in a different direction, and happy to kind of go into that.
Yeah, and I wouldn't mind if you can double click on this and kind of like what were the lessons learned in this case? If it's like, is it like if it's a competitive situation and you do the risk assessment, you assess that your chance of success is low, you back out of it and focus on kind of tell me, what did you learn from it?
That low mid-market and mid-market private equity firms are very good at doing this. And
Okay.
there is a high degree of cynicism still amongst sell-side advisors when it comes to independent sponsors. So I think if you kind of think about where the market's been at for the last probably not even 10, 20 years,
Mhm.
the very established and well-trodden path in M&A is for founder-built businesses. They get to a certain point and they either take growth capital or they do a majority buyout transaction to PE.
Yep.
And P firms are exceptionally good at the execution of those, end to end, from origination through close and growth. But the market has changed materially in the last couple of years, and there is a significant amount of pressure on blind pools and blind funds. There's a lot of LP skepticism around those funds, particularly where they're cross-vertical and not specialist, which is a lot of them. And the sell-side advisory market, in a lot of cases, hasn't adapted to the ability to execute that independent sponsors bring, but also the different nature and shape that an independent sponsor can have through a transaction with a seller. And my point to the seller was, a transaction with me is going to be far more collaborative, where I'm not dictating terms. We're negotiating. It has to be right for me, but it has to be right for you as well. And you'll hear that from private equity. But when you began this process, a year ago, you didn't want to sell to private equity because of some preconceptions. And some of those preconceptions are right and some of them are wrong. But private equity does have a label or a set of labels, and a lot of those are right. And this seller was, hesitant about going down that path. So
if I could just double click on this, Robin, I mean, if I think about from a values and principle perspective, it seemed that like you were better aligned with the vision of the founder. The founder wanted to make sure the private equity company doesn't come in and gut the company and then sell it for scraps, or we're just going to do a flip. You were very much aligned with the vision of the founder. You provide him optionality in terms of how he stays on or how he leaves and when he leaves. And so did it all come down to money? Is it all matter of valuation?
It came down to two things. It came down to sell-side perceived risk of an independent sponsor. And it's a valid risk, right? Because a blind pool is committed capital, cash in bank, and they can evidence a balance sheet in a process. And the cash is there. I had commitments from LPs, but it wasn't cleared capital. So in a competitive process, there's degrees of risk, right? And when I first looked at it through the eyes of a search fund, I liked the structure of a search fund, and the CEO liked the idea because it's highly entrepreneurial and he's an entrepreneurial chap. But sell side hated it because every single one of your LPs is a equity gap risk, right? So I get it. And some friends of mine in the industry kind of aggressively counseled not to go down that path. So I ended up effectively at a halfway house with a smaller group of LPs that were family office and kind of small institutional shaped. But did I have the deliverability that a closed-end fund had? No. So that was the first part. And the second part was valuation. So I did a bottom-up and top-down valuation of the business at a conservative but reasonable valuation. And sell side round one clearing price was 2 turns of revenue above that. And I would have struggled to have got there. Now,
Wow. Okay.
what's going to happen and what will that deal clear at, given it was software? We
Yeah.
will find out. But my
Yeah.
strong expectation is that it will either have retraded or be in the process of retrading at the moment to
Yes.
probably less than where
Cool.
I was at.
Yeah.
And that's a really tough thing for founders and CEOs. And I was chatting to someone in a different vertical yesterday, and I said, now is a really rubbish time to try and sell a software company, because you don't want to be the CEO and seller of a business that is the first to go through IC in this new world. And
Yes.
I don't think we have an established, we probably do in larger businesses. I don't think we've established revised clearing prices in lower mid-market. And
Mhm.
as a seller, you don't want to be that person.
Mhm. Mhm.
So, and the I've spent most of this year looking at the capabilities that AI bring to businesses as a whole, not just software businesses.
Yeah.
And it's made me fundamentally rethink my thesis on acquisitions. And that's
Okay.
possibly a good segue to go into what's next. But
Before we jump in there, I definitely want to go there because we've seen this across all the companies that we work with, um, on valuation, because this has been a major topic of discussion between us and clients, right? We're a capital advisory firm moving into the investment bank space. Um, a very frequent topic of conversation is, how do we get to humility in the valuation? Every founder believes their company is worth gazillions of dollars, and we'd love to be able to achieve as high valuations as possible. The risk that we are running if the valuation is not fair and reasonable is that the person on the other side doesn't take you seriously, because you're like, well, what is this based on? Is it based on revenues? Is it based on EBITDA? Is it supported by benchmarks? It like latest transactions? And so, talk to me a little bit about, how do you get founders to be humble about the valuation? Because you said the sell side, or the private equity company, had 2 turns higher based on revenue valuation. So, how do you bridge the gap between what's realistic?
yeah, I think it's comp sets. And one of the challenges that private markets have is the opacity of data, right?
Hmm.
Like, and a lot of it's word
Or
of
lack
mouth.
of. Yeah.
So that is a challenge, but I think in fairness, that's where, and I'll be really candid. I appointed a buy-side advisor
Hmm.
um, because the sell-side advisor was pretty heavyweight, and I
Yeah.
wanted to make sure that I was toe-to-toe. What I didn't realize was all the color that buy-side advisor would bring, and
Yeah.
color around competitive transactions, market, LP and GP behavior and interest. I didn't expect it, and I was blown away by it. And
Hmm.
uh, I would definitely advise anyone looking at and this was a 8-figure transaction. Anyone looking at kind of 8-figure transaction, from the buy side, appointing dedicated advisors, not just legal and finance and QE,
Yeah.
but actually, folk that are going to run the transaction, super important. And the leader of that, for me, has just been made up to a partner at the firm he works for, thoroughly well deserved, and you could see it. So super valuable people. The other
Hmm.
part of it is culture. So I did a mini process where I spoke to probably 6 or 7 advisors. Buy
Hmm.
side is tough, right? Because it's 100% contingency.
Hmm.
And a number of tech specialist firms didn't like the look of it because it was competitive, which makes complete sense. A couple of them culturally were not the right fit for me.
Yes.
They were very, what's the best way of describing it? Probably pointy, like quite aggressive. Um, just weren't the right fit for the culture that I was trying to put into the deal. And then, who I ended up working with, the culture was the single biggest part of why I decided to work with them. So that's super important. So yeah, I think those two areas, kind of the comp set is really important, but actually the advisory side of things really helps triangulate valuation. So what was really validating for me is that I did bottom up, top down, as did a number of other folk that were looking at the IM, and we all basically triangulated to within half a turn of revenue. With
the exception of the P firm.
With the exception of 3 outliers, 1 trade and 2 P.
Okay.
And there were some market drivers on why one of those P firms was a fair bit higher than where I and other bidders were.
And why is that? I mean, obviously, if you have multiple buyers coming up to a similar valuation, and then you have 3 firms that are exceptional, what assumptions in the valuations kind of drove that differentiation?
So one of them had significant adjacencies that really made a difference, and adjacencies that could lead to synergies. Both horrible words, but they were going to be able to do that. Both of them had meaningful conviction because of those adjacencies on the vertical, so they knew it cold. And also, being frank, one of them was significantly underdeployed, like really underdeployed. And so that was
deploy that capital to make sure they start to generate returns. Got it. So situation for them. Okay. Interesting. It's always interesting to see how a deal unfolds, and the search space has absolutely exploded in popularity. Like, we get all the time inquiries. Can you help us find this firm? Can you get it? Like, and in some cases, people are looking for boring businesses. Like, one of our clients bought a metal shed fabrication company, right? Like I would have never thought about it, but it's industrial, it's stable, it's always in need, farms need it, businesses need it.
And you're probably looking at, I don't know, 3 to 5 times EBIT valuation rather than a 5+ times revenue valuation, which is where software's at. And don't get me wrong, I've worked in software for 20 years, and it's a career and a profession and industry that's done me good, and I thoroughly enjoyed it. But every person I speak to outside of software, when we talk about valuations, it's just like, this is so disconnected from every other thing. And my stock response had always been recurring revenue, like banging the drum that everyone does. And I remember speaking to, he's going to be an advisor of a new business that I'm building at the moment, which we can come on to. I was chatting to him like a couple of years ago, and I said he runs a 200-person engineering team in a private equity-owned software company. And I said, what is going to dislocate these valuations? And neither of us kind of called it right. COVID initially did, but then no one saw how meaningfully disruptive Anthropic's co-work release from, it was like 2 months ago, if that was going to be. You'll probably have the numbers close to hand than I did. It was, it was hundreds of billions of market caps had evaporated. And I, like a load of other people in the industry, I'm sure, have had a load of conversations about it. But and until January, February this year, I was cynical about the impact that frontier model companies were going to have on the software industry. And I thought that a lot of the rhetoric coming out of tech dedicated P firms around agentic AI was massively overblown. And that changed when I ran a valuation through Cowork for a much smaller tactical acquisition I was looking at doing. And the modeling was like nothing I'd ever seen. And I pinged it over to one of my sort of mentors stroke LPs. And I said, hey, this stuff is insane.
Yeah.
This is insane. So he then put a model through Claude and for a transaction that was a bit bigger. And that was his wake-up call. He said, like, what this has done is a week of work. It's done it in 2 hours. I then had to spend 4 hours tweaking, but this is a game changer.
100%.
And it's that, and that was analysis work. So, that's directly impacting junior entry-level roles. It's significant.
Like analyst work, yeah.
I've got some work experience students working for me at the moment, and I'm giving them Claude subscriptions and saying, you have an opportunity to grow up with this stuff into a job. This stuff is, really worth you getting your heads around.
I mean, we have 20x subscriptions to Claude, multiple, and we celebrate when we hit the wall, meaning that when we have capped out and we have to wait for it to reset, because that means that we're making full use of it.
So it's funny you say that. So I've had a 5x subscription for 6 weeks, and I'm actually using it to build quite a bit of software at the moment. And there's a really cool tool called Opcode, open source tool that you can stick in front of your subscription, and it tells you your real world token use. And to give you an idea, my 5x, I'll send you a link after, or we can drop it in the comments when it goes up on LinkedIn. My £90 a month 5x subscription, I used like $1,200 worth of real world tokens last month. So the Anthropic subsidies are huge and are coming down at the moment. I've just moved to a 20x subscription because my entire view on software has changed in 3 months. And my personal view with what I'm building next, a roll-up called Stayed, and we can talk about that in a minute. But my personal view is that the future of software is highly commoditized in terms of any user interface into a database, any CRUD application. It's kind of like, well, they really don't have material value anymore, certainly commercially. So I've just built, we've got new tax legislation coming in the UK called Making Tax Digital. It's some of the biggest kind of tax change that's hit self-employed people for a number of years. And effectively, we're moving from having to report to our tax authority every 12 months to every 3 months, depending on revenue clips. And it's meaningful. It's painful regulation. And I've built a tool that for a very specific vertical for short-term rental property owners that basically does that. And I'm going to open source it. I'm going to make it available to people for free. And my kind of thesis around software is effectively that there is no meaningful intrinsic value in software like that anymore. Full stop.
So let me double click on it. So I mean, I'm a business person and I code like crazy now. Now I was talking to a friend of mine. He's like, no, what you're doing is vibe coding. I'm like, not quite, because I'm not using the Replicator cursor. I'm in Visual Studio writing code. I have a GitHub account. I have a branch, but like I wanted to kind of double click on this. If I completely agree, the software space is being disrupted. Even in our company, we're constantly building software and systems for clients and for ourselves internally. What are the modes that exist for software company? Is it data? Is it distribution? Kind of like, because I mean, if one-off applications, I get it. I completely agree. If somebody tells me SAP is going to disappear, I don't believe them. But kind of like, what are the only modes left in the software space?
Yeah. So, I mean, with the example I've given you, so, people want to Making Tax Digital spreadsheet. There's a full macro driven one free to download, or will be. I'm still just going through QA, and I want to get an accountant to validate it all to make sure that we're kind of good from a calcs point of view. My SaaS tool, free, no value to that. if people want
Yep.
support, I'm working out a commercial model because support is my time. I'm working out a commercial model to make that work, and I've got some ideas. But to your question, I think we're at the point where software has value where it does work, and if a human user has to input data into it, it has a bit of value, but I don't think it has really meaningful value. So in my mind, that software is free. I'm then going to build a fully automated tool that through MCP, it's possibly getting a bit technical for some of your users. So through some new integration software, will effectively pull revenue data automatically from the source of revenue. So the user's not having to key it in, the tool goes and gets it. They automatically throw their receipts at the tool and they get OCR scanned. That's not that complex, but the tool will also categorize the spend against the tax coding. That has value. We'll then bundle that up and automatically send that to the tax authority. So that has intrinsic value. Like that's me as a consumer of that technology, stepping away from the keyboard and having to key stuff in the old world, and moves to the agentic world where the technology is doing work for me. So I spent a lot of time thinking about the principles of this business for a number of reasons, largely to do with the potential impact to automation of work. But my software views are interface, database, not much value. When the technology starts doing the work for you, and you're now competing not for a technology spend, but for a human labor spend, for your time, that's where value is created. So my philosophy on software is, if I'm doing stuff that saves time genuinely, it has value, I'll charge for it. If I'm not, it's free. So that's my philosophy. And I think I'm in a quite envious position, and I've chosen it very deliberately, where I have no technical debt because there is no business before me. The huge challenge and why all these valuations are recreating at such a rate and pace is for a couple of reasons. Firstly, these businesses have colossal technical debt, like colossal.
Agreed. So for them to refactor, it's a major endeavor versus starting fresh with a blank slate.
And again, for the non-technical people watching this, technical debt is effectively the software was written in an old school or legacy way, and it takes effort to bring it up to a modern standard, but you don't really get any incremental gain other than more modern technology. So it's a really hard investment for a business to justify, because you can argue it kind of makes your bottom line a bit leaner, but that's tenuous and it doesn't ever really increase your top line unless you introduce new stuff. So a lot of companies are in that position. Secondly, most of them are recurring revenue businesses where most of their revenue comes from their existing customers, and you have to continue to serve those customers because they're keeping the lights on, and you have finite resource. Let's say you've got 20 engineers, and until AI came along, those 20 engineers were split, I don't know, like 15 working through feature function bug fixes for legacy customers and 5 of them working on new stuff to get new customers. You've now got this kind of AI wrecking ball, and it is that severe, right? Slamming through your business with your investors breathing down your throat on what your plan is, your customers not really caring about AI, being frank. Like, if you look at the consumer applications and how hard Google in particular trying to drive people to use their AI capabilities in workspace, it's kind of like, well, I don't want to, right? Like, my AI workbench is somewhere else. Don't force it on me. So there's a whole load of pain running through these software businesses at the moment, where they're trying to look ahead of the curve to work out where to get to and where the puck's going, but they're still having to keep the lights on in their existing business. And I think we're at a really early point of this as well. I think the cost of tokens, so the consumption unit of the AI models, is only really starting to become clear kind of now. Opcode's a great example of what is the real cost. Let's assume that the subsidies from Anthropic and OpenAI disappear tonight, what's the real cost of me building this stuff? Well, now it does have a cost. Businesses are also having to adapt to that.
And if you look at stats, like in terms of AI, majority of the, like these kind of like 1 or 2% at the top, that they're driving majority of the use, and they're getting a lot. To your point, you're paying $100, but you're getting $1,200 worth of value, versus majority of the people who are paying maybe $20 subscription, but they're not using it. They're using it kind of as a chat prompt rather than as a tool that does things for you.
Yeah, and I mean, computationally, and I see this in my own account, I'm sure you see the same. When I'm bouncing around ideas and thoughts on business models, my token consumption is like, it doesn't move the dial. When I'm writing software, debugging it, testing it, when that code base becomes, 20, 30,000 lines, and I'm having to find problems in it, then the token cost is huge. So we're all the smart ideas in all the incubators at the moment are going to be around spend management of tokens, because we had it with FinOps, where people were exposed to their compute cost with AWS and Azure, and people built financial guardrails to manage that. Token management is the big investment area at the moment, where a lot of startups are spending a lot of time.
What are some of the things that you do? I mean, like, for example, like I always compact when I'm at a 50, 60%. I try to manage kind of like what MCPs are connected when I'm doing specific work. I try to plan out my work as much as possible before I go into execute. What are some of the things that you're doing to manage token use?
I would love to say that I was doing it efficiently, but I'd be lying to you. Like, emphatically, I'd be lying to you. So for context, I've got a computer science degree, joint honors with business, and I got a first, like a very strong mark in the business side of things, and I, quite possibly got quite a lot of external assistance writing all my software at university from other people. So, am I a software developer? No. Am I dangerous? Yes. Do I understand kind of what good design patterns look like? Yes. Is a lot of what I'm building going on GitHub? Yes.
Yeah.
Is my token consumption efficient? No. I think, but that's a learning experience that I think is really important. And going back to my point on the challenge legacy businesses have, I have the luxury of no legacy business, a plan that requires me to build software, and I don't have a lot of time, but I do. I'm not having to do legacy work. So, I'm working quite possibly the hardest I've worked in my career, but also with the biggest smile I have on my face, building stuff. But again, if you're an existing employee in a business with commitments and responsibilities pre this AI revolution, that's a really hard place to be, because the business isn't going to be able to give you the time to work all that stuff out. So, I have the luxury of time, kind of, but I have the luxury of being able to make mistakes.
Yeah.
Because I also don't have, I'm at 5 figures of ARR in my new business, and we'll talk about that in a minute. So I have paying customers for some of the stuff I'm doing, but I'm not having to worry about 100 customer base, and therefore can, really push frontiers on some of the new stuff I'm working on without much risk.
Yeah. Awesome. Oh, that's probably a good transition. Let's talk about state, short-term rentals. What are you doing to disrupt the space? Aggregate, roll up.
So the timeline accelerated. So at the start of the year, I was chatting to a friend of mine who chairs private equity-owned healthcare businesses in Europe. And he had kind of listened to my journey and story with the transaction I failed to get over the line last year. And I've owned a holiday home in the Cotswold Water Park in the Cotswold Lakes in the Cotswolds for 10 years. I had 2 for a bit, but most recently for 10 years. And it's always kind of been a side hustle. I was quite late to pensions because I worked for startups for the first 10 years of my career. And my wife is a teacher, house mistress in private boarding schools. We don't live anymore. So we bought a holiday home to escape to on the weekends when the family were living in boarding house. And a couple of years ago, I had a few months off, and I'd never really looked at that financially in detail,
Mhm.
and I put a lot of thought into revenue management. And
Mhm.
roll forward, I went from doing about 10% gross yield on asset value to 20% gross yield on asset value in 2 years. And I was chatting through this with my buddy, and he said, "You should go and
Mhm.
set up a holiday home agency." I was like, "Hell no, I don't want to do that." But rolling up holiday home agencies, that's interesting.
Yeah.
So roll forward, and I've just got my advisor agreements out to a proposed chairman who comes from the short-term rental industry. A couple of advisors, one who exited a software business in the short-term rental industry in Europe recently, another
Mhm.
who was ex-CTO of one of the agency roll-ups, so just agreeing
Mhm.
terms there. And I'm looking to do 3 things. So firstly, I'm helping owners with revenue management,
Mhm.
using dynamic pricing, and a lot of the tools and tactics I've used to double my gross yield on my property,
Yep.
other people really aren't looking at. So
Yep.
offering that as a paid service to people,
Yep.
that's very performance based. So if I don't deliver, I don't get paid. If I
Yep.
do deliver price and occupancy improvement, I get paid.
So can I
Secondly,
just double click on this for like, do you see the software space evolving to exactly what you're describing, where it's not a license, but it's outcome-based pricing?
100%, yeah, and that's why I've been very conscious with my pricing decisions here. And I think this rolls through to the agency model as well. It's a bit ethereal, but I'm consciously pricing my services for outcomes only,
Mhm.
with a degree of retainer, because I do have some sunk cost in terms of technology, but it's trivial. But then I
Yep.
really want to move to shared upside, and I've been wanting to do that for years. And
Mhm.
when I was in go-to-market and sales roles, it always amazed me, being frank, that I got a flat percentage of deal value, regardless of what margin I sold technology at. And the
Mhm.
technology was always high enough margin where I could get paid, but I was never really incentivized to sell high margin,
Mhm.
or outcomes for the business. And
Mhm.
it always amazed me. And the mechanisms in place for that kind of thing were deal desks in software companies, where you've effectively got a RevOps team telling you what you can price stuff at.
Yeah.
It's not really kind of outcome, or
No.
it's not real outcome selling. So yeah, my pricing is very geared around outcomes, and the revenue optimization and management is just a nice way for me to grow the business kind of organically. Secondly, I'm looking to build automation workflow for holiday home and short-term rental agencies. So they
Yeah.
are hugely administrative heavy, and there is a meaningful opportunity to automate a lot of the painful work that those people have to do.
Okay.
They're
Okay.
not efficient businesses in the slightest. And that will then free up the employees' time to spend a lot more time with owners and guests. There is moral hazard there around that technology being used to take jobs away.
Yep.
So I spent a lot of time thinking about founding principles and the ethics of the business. So I want it to be a B Corp. That will be problematic
Okay.
for some potential investors, but that's by design. And
But why
the
not? I mean, B Corp is a beautiful designation. It means that you're benevolent in your design principles. You're going to designate some of the profits towards benevolent. Like, why would this be problematic for an investor? In my mind, I mean, one of my early clients was Benevity Social Ventures. It's a B Corp. They're several $billion in valuations. I would think that what's good for humanity, it's good for business as well. It's a for-profit corporation.
Yeah, I think so. I think in most cases it's fine, but you do have to make changes to in the UK, your articles of association, which dictate the governance structure of the business, and
Okay.
you effectively move from having to not quite solely, but predominantly cater to the interests of your shareholders, which is the kind of bog standard template of a
Hmm.
limited company
Hmm.
in the UK, to having to consider the impact of the business on not only your investors, but your employees, your customers, and people in the community. Those are all good things, but you have
Okay.
to take, there's a but, well, not a but the thing that can lead investors to raise their eyebrows is you must take into account the impact of a transaction or a sale of the business to all of those stakeholders. So effectively, if the transaction is not to the benefit of all
The
of those
shareholders.
stakeholders,
Yeah.
that's a problem.
But to me, that signals, from a design thinking perspective, that drives endurance and longevity for the business, because they're considering this all stakeholders rather than just the shareholders.
100%. But I mean, going back to my example earlier, let's say that, and this is not the plan, but theoretically, I'm a few years in and I need to raise dilutive equity, and the market's at a point where I'm a bit constrained, and my only source is a closed-ended blind private equity fund that is moderately deployed, but at the back end of the fund life cycle.
Yeah.
I know that I'm going to have 2-3 years tops to deliver a return to that investor. And what that means for my business, my employees, my stakeholders, my customers, and my community, that's a problem.
Yeah.
And it's going to be a problem for the investor, and it's going to be a problem for me. So it effectively gates because it has to be declared up front, it effectively gates investors like that. And is that a bad thing? No, I'm designing it that way very consciously. But will it be a DD flag for investors? For sure.
Yeah. Understood.
But I mean, so there's a really interesting business called Dwelly that dramatically accelerated my plans about 6 weeks ago. So for those that don't know, Dwelly was founded by a couple of execs from Get, the London cab ride-hailing service. And they're doing a roll-up of buy-to-let agencies, so longer tenure residential agencies. What's really interesting about them is their funding structure. So they raised venture from General Catalyst. And and a big chunk. So they've raised 70 million across debt and equity to do a roll-up of buy-to-let agencies. And their thinking is the same as my thinking. So they're effectively looking to, and the description doesn't quite work, but it's a really succinct way of thinking about it. They're effectively looking to buy their customers. So they're building a lot of workflow automation and tooling to run buy-to-let agencies, and the product is the acquisition of those businesses. So they're not building software to sell software to buy-to-let agencies. They're looking to buy the agencies. And my end goal with Stade is exactly the same. So I'm looking to be a ethical and partner-orientated acquirer of short-term and holiday home agencies, initially in the UK, year 2, year 3 Spain, and against those B Corp principles, and following a lot of the succession thoughts that I had with Corinium last year. There are a number of founders of those businesses who are heading to retirement, and there's no natural succession for them, or a home where they want that business to live. And I want to become that home. So 3 strands: revenue optimization, building agentic workflow for agencies, but with the end goal being to acquire those businesses.
So Robin, if you don't have the deep pockets of General Catalyst, how do you plan to win against Dwelly? And I mean, I see your positioning, it's intentional. How would you get an agency owner to sell to you, or maybe equity swap, or whatever it is? Kind of walk me through some of your thinking.
Yeah. So firstly, and Dwelly is thesis validating, not competitive. So they are 100% focused on buy-to-let, longer term residential tenancies.
Okay.
Investors like that because it's not recurring revenue, but it's stable revenue. There
Yeah,
are
you
some
might have a
gotchas.
vacancy up here, but the revenue is there. Yeah.
Yeah, there's actually a lot of headwind there, but it's probably not for today. But there's a lot
Okay.
of legislative change in the UK that means that actually a number of investors in long-term rental are moving to short-term rental. So the revenue is not quite as kind of sticky as a lot of people think it is, but they've got a war chest to go and buy a lot of buy-to-let companies.
Yes.
They're not going, or I'd be very surprised if they were actively looking at short-term rental because the workflows are completely different. Where long-term rental, you get a tenant change at the quickest every 6 months. In short-term rental, the quickest I have my guests changing a couple of times a week. So the workflows are completely different. Business model is different as well. Buy-to-let agencies typically charge between kind of 6 and 10% of rent value. Short-term rental agencies charge up to 30% of a guest stay. So very different businesses. Complementary. It's thesis validating in terms of buying the customer. And has been hugely, to your next point, hugely validating to the investor conversation. In my discussions with investors, I can say, I'm looking to do what Dwelly are doing in an adjacent market. And when someone like General Catalyst and a debt provider have dropped 70 million for doing that, thank you very much to General Catalyst. And I can't remember who the debt partner was, but thank you, because my life has become infinitesimally easier in terms of explaining what I'm trying to do. And so that kind of covers adjacency and capital. To your point on convincing, I think it goes back a bit to what we were talking about at the start of the podcast on the perception around private equity. So there are this is a trodden path. So there have been three-ish, a few more, but three big aggregators of short-term rental businesses in the UK. I think without exception, every single one of those was private equity backed. One of them, I think, is now exited, or a couple of them have had multiple owners. And some of those exits have worked really well for those founders and for the teams. Some of them haven't. And getting to know the community of agency owners in the UK, again, there are kind of two choices. They can sell to one of the big aggregators, and there is a cost that comes with that to them and to their team, or they can take a different path. And one of the things that's going to be very important around Stayed is a partnership model where, should a founder and owner want to remain in the business and help grow Stayed as a group, they will absolutely be able to do so, but become part of a partnership that gives them equity upside on the EBITDA arbitrage. And that's something that's not really available to them today, but something that I think is really important. And there are some structural things in the short-term rental space that make that very hard for owners to get past. So you hit a couple of clips where operationally your business becomes very difficult to scale. When you're looking after 50 properties, that's a natural kind of tipping point where your life gets very difficult, because you by and large then got to start expanding geographically, and that's operationally very painful. Or above 100 properties, similar scale, multiple by 2. So it's very difficult for those agencies who have aspirations to become something much bigger to scale the business. And the EBIT sort of multiples of these agencies are conservative, and therefore aspiring owners who want to be part of something bigger, their options are quite limited. But also it's more around the technical side of things. Like, I'm so certain that how work is done is about to materially change. I really want to drive that innovation without any technical debt or organizational debt that the aggregators before me have had. and the technical debt that those organizations have is meaningfully non-trivial. Whereas I'm starting with a fresh slate. So I'm doing a couple of things. I'm helping a couple locally grow their agency. So that's giving me exposure to all of their workflows and all the work to be done. And I'm starting to have some pretty interesting conversations with some agency owners who are very interested in the idea and are quite interested in becoming part of something much bigger. So the bags under the eyes, I've always had bags under my eyes. They are bigger than they have been historically, but the smile on my face is a lot bigger than it's been as well. So super exciting.
What? I probably work harder now than I have ever worked in my life. I mean, partly because we have a lot of European customers. I start every morning at 5 o'clock my time, and then just to create as much of an overlap. But I'm like a kid in a candy store because of the velocity with which you can operate. Like, I'm very results oriented. So seeing these outcomes come to fruition like so quickly, it just constantly feeds my energy. And so the other thing that we have a saying within our firm is that if it can be done on a computer, it can be done using AI. There's just no reason why it can be. So it's just pretty exciting.
It really is, and that's another thing about a couple of people have said to me. I was sat down with an old colleague a month or so ago and was talking them through the business plan. And they said the fundamental problem with this business plan is you can't fire enough people. And that person had worked in private equity for a long time. And I said to them, that's what made me go and write my principles, right? Because I said, well, that's kind of the point. I think, and I've got this in the principles of the business. I think we as kind of custodians of businesses have the ability to be part of the solution or part of the problem that AI presents. And I would far rather be part of the solution than part of the problem. And the problems are going to be meaningful. I'm short-term pessimist, medium-term optimist, but I would far rather be part of making that cool and meaningful than crappy and a reason why loads of people lose their jobs.
For sure. I mean, we are in the process of launching the Future Ventures Academy, and it's the biggest intent there is no question AI will displace jobs, but I see jobs as a collection of tasks. Some tasks are better suited to your point around the financial modeling. Now, is Claude Cowork perfect in its modeling? Does it make mistakes? Yes, it does make mistakes. It's not perfect, but it compresses work significantly. So it's kind of like, how do we help people like you and I that are AI native, that have adopted the tools? How do we help them become that?
Yeah, completely agree. And a couple of thoughts on that. Firstly, I live about half an hour from a town in the UK called Cheltenham, and Cheltenham is where the UK's equivalent of the NSA is. So our security services, GCHQ, based in Cheltenham. I've got a number of friends that either work there currently or have worked there before, and there's a vibrant security industry there. So I'm running the first Anthropic meetup there next week.
Good.
Set it up a couple of weeks ago. We've got like 60 people coming. It's insane. Got a few friends speaking. So fostering community, I think, is really important, and fostering community for technical and non-technical people.
Agreed.
And then secondly, I've very consciously chosen this vertical for a reason. Firstly, I know it because I've got a holiday home and I understand revenue. But secondly, it's about selling something really nice. Like everyone likes going on holiday, and it almost comes across as trite, but actually, the strapline of the business is short stays reimagined. But I can't think of anything better than making someone's holiday better, and the businesses that work in that space better. I've worked in some verticals and industries that are, they don't have that fun element and delivering something really cool to people. So I'm doing an event in a couple of weeks at a multi-million-pound property with some folk just getting together to network and chat about their experiences renting out holiday homes with a private chef and some really cool drinks and some people in the industry talking. It's just it's like it's a nice industry. That's the other thing. Everyone in it is nice. Like the people that run holiday home agencies are fundamentally good and nice people. So that's a good thing as well.
That's awesome. Robin, I know we're at time. Anything else that you would like to share? Where can people follow you? How can people learn more about State? How
So
is there like alpha beta that's like rolled out?
So couple of channels. So I'm there's lots of Robins, but there's even more Smiths. So I'm Robin Smith on LinkedIn. The company name again is Stayd, STAYD. Website stayd.uk.
Okay.
And I'm going to be sort of more formally launching the business at the UK's leading short-term rentals trade show in a couple of weeks' time. But yeah, if anyone has any questions or queries, is interested in what I'm doing, if I happen to find someone who's a podcast listener who is interested in selling their UK-based short-term rental agency business, please drop me a line. But even if you're not and just want to chat,
Absolutely.
It's very much about just getting to know folk. The more people I get to chat to, the better. But thank you very much to everyone for tuning in and listening, and Maxim, to you for getting in touch and suggesting that we get together on a podcast. I think it's my first one actually. There must be something in the water because I've been pinged about doing a few more. But thank you very much for reaching out. It's been a really enjoyable conversation.
Absolutely love it. Thank you so much. Thank you so much, Robin. It's been a pleasure. And in hearing your insights and how you're thinking about the industry, it's definitely, well, at least from our perspective, you're dealing with a lot of founders and VCs. Definitely the way the industry is headed. So thank you so much.
Thank you.